that foreign central banks now officially hold more gold than U.S. Treasuries for the first time since 1996. But look at the percentage of foreign central bank reserves that were in gold back in the 70s and 80s and where we are today. With the distrust in the dollar and with all of the accumulation that you're seeing with foreign central banks, this is going to be a very steep upslope on this side of the curve, and it's going to continue. So let that sink in. If you think this buying streak is ending, just look at what happened in the 70s. This is likely the beginning of the most significant global rebalancing we've experienced in recent history.
For the first time since 1996, foreign central banks now hold more gold than U.S. Treasuries. This single data point marks a turning point in global monetary history. It's not merely a symbolic milestone. It's a fundamental repricing of trust. For decades, central banks measured their wealth and security through holdings of U.S. debt, treating treasuries as the ultimate safe asset. But that era is ending. As Mike Maloney highlights, the shift away from paper promises toward tangible reserves represents not just a diversification, but a wholesale reevaluation of what constitutes real money in a world losing confidence in fiat systems. In the 1970s, gold made up as much as 70% of total foreign reserves held by central banks worldwide. Today, despite years of steady accumulation, that number still sits near 15%, meaning there's enormous room for expansion if central banks continue their historic buying trend. The World Gold Council reported that in 2023 alone, central banks added 1,037 tons of gold, the second highest annual total on record. Meanwhile, the same institutions have reduced their U.S. Treasury holdings by over $900 billion since 2021. The implications of this reversal cannot be overstated. As confidence in the dollar erodes and fiscal deficits balloon, gold has reclaimed its place as the only universally trusted store of value, one that no government can print. If global reserves were to return to the 1970s average of around 40 to 50% gold backing, the math suggests a gold price several multiples above current levels. Even a modest doubling of the current allocation from 15% to 30% would require the purchase of tens of thousands of tons of additional gold. A feat that would stretch supply chains, drain Western vaults, and ignite a structural price surge that no futures market could contain. This is the kind of long-term repricing event that redefines the entire hierarchy of global assets. And what follows gold always affects silver. As the monetary system tilts back toward tangible value, silver, the historical ally of gold, becomes the leverage play. Industrial demand continues to outpace mining supply. And as Maloney points out, the market now consumes more silver every 6.8 minutes than miners can produce in nearly 10. Without a dramatic repricing, the balance simply cannot hold. In today's analysis, Mike Maloney connects this extraordinary central bank realignment to the deep undervaluation in both gold and silver, showing why we may be standing at the threshold of the biggest precious metals revaluation in modern times. Later, Schiff takes this conversation further, breaking down how even record-high stock market numbers disguise a collapsing reality when measured against honest money. Before we begin, please like this video, subscribe to our channel, and share your thoughts in the comments below. We appreciate the support and hope you enjoy the video.
39% of fund managers surveyed are gold broke. That's 39, and it looks like it was about 41 or 42. It's 39, so these people that have no gold whatsoever, these fund managers, and I love this, money managers who don't know the first thing about money. They don't because they're not buying money. They're invested in things that are everything's measured in currency to them. So 39%, 20% of them have 4% gold exposure, 16% of them 2%, 8% of them have 6%, and 6% of them have 8% or more. Only 6% have 8% or more. And I guarantee you there's going to be a day where all of them are going to have some exposure, and it's going to be at least 10%. Money managers, I don't know if they had these funds then, but brokers and so on, they didn't recommend gold back in the bull market of the 70s. It wasn't until after it was too late that they started recommending, put 20%, 25%, 30% into gold. And then that became less and less and less until it's, just 10%. And then it basically, by the year 2000, when gold was just $250 an ounce, they're saying don't put anything into gold because it's dangerous. You could lose. And because they want to sell you their products. And then you hear this fallacy of, just put 10% into gold because gold is so volatile, it's dangerous. Well, it's been the best performing asset of this century, other than cryptos, but when you start at zero, from 0 to 1 is an infinite return. So, Make Gold Great says, we mine this amount of silver every 9.6 minutes. We use this amount of silver every 6.8 minutes. This will end well. So we're using up this 6.8 minutes. We use up as much as takes 9.6 minutes to mine. Something has to give, and what has to give is price, so that this eventually slows down to match that. Or the other thing is that enough miners can go out at these, we need some astronomically high prices to cause a silver rush of miners to open up new mines. And so we need this to meet this right here. Except what's going to happen is astronomically high prices will cause a lot of the uses of silver. They're going to be very, very frugal with the uses in industry. So we might be able to use up this amount of silver every 9.6 minutes instead of every 6.8 minutes. Who knows? But these things have to reconcile eventually, and they will, and it's going to be through price. Tavi Costa points out that foreign central banks now officially hold more gold than U.S. Treasuries for the first time since 1996. But look at the percentage of foreign central bank reserves that were in gold back in the 70s and 80s, and where we are today. With the distrust in the dollar and with all of the accumulation that you're seeing with foreign central banks, this is going to be a very steep upslope on this side of the curve, and it's going to continue. So let that sink in. If you think this buying streak is ending, just look at what happened in the 70s. This is likely the beginning of the most significant global rebalancing we've experienced in recent history. You need, Tavi, you need to drop the word recent out of there. In history, period. What has happened is we went from full gold backing before World War I to 40% gold backing when we opened the Federal Reserve. Then there was a shift in the world monetary system with the Genoa Conference of 1921. But we've gone from something rock solid to a little bit less of that something, 40%, to the Bretton Woods system, which had no reserve specified, and it fell to 8%, to nothing when Nixon took us off of the Bretton Woods system in 1971. And now we're going to go from nothing back to something in a huge, giant step. It is probably going to be the biggest event in monetary history, period. And so I think we are in for something really big. These are some pretty exciting times. Mr. Yuppie, history rhymes. Gold now makes up 15% of world reserves, the highest level in 30 years. And like I said, this side is going to be a very steep.
Yesterday, December gold futures traded above 4,000 for the first time ever. In fact, I think they closed above 4,000. And that became a pretty big news story, at least in the financial media. I listened to quite a bit of coverage of $4,000 gold, although technically gold was not at 4,000 yesterday because the December futures contract is the price to pay for gold that's not going to be delivered until December. The spot price is what I pay attention to for records. And yesterday, spot gold never quite made it to 4,000. I think it came maybe $10 away at its peak. but it didn't get to 4,000. Well, that changed today because spot gold blew through 4,000. In fact, the intraday high, I believe, was 4,050 something. So we got more than $50 above 4,000. I think, gold was up better than $70 on the day at its high, although it closed off its high, maybe up about $50, $55. And as I'm recording this podcast live on Wednesday evening, gold's down another $23 in early Asian trading. So it's trading back below 4,020, but it's still holding above 4,000. Now, look, obviously, gold could go back below 4,000. I mean, that's not some kind of line that can't be crossed. And it's hard to say whether or not we're going to have a pullback from here. I mean, certainly the market is due for a pullback. I mean, we've come a long way. In fact, year to date, the price of gold is up 54%. I mean, that is a huge move. First of all, the year's not even over yet. We still have most of the fourth quarter left. But the last time gold was up this much in a calendar year was the 1970s. So in terms of gold, the Dow was down. In fact, we just ended the third quarter a couple of days ago, earlier this week. I think Tuesday was the last day of the quarter, or Monday? No, Tuesday. Gold was up 17% on the quarter, 17%. So the Dow had a negative quarter priced in gold. Silver was up 29%, but let's just price it in gold rather than silver. So on the quarter, I'll just have to do it by memory. The numbers aren't going to be exactly accurate. I thought I wrote these numbers down, but I don't see them. But the Dow is worth 12 ounces of gold right now. It was worth, I think, 17 ounces of gold at the end of last year. So we're down about, 27%? Again, 27% on the year. 27% priced in gold. Now, if you go back 2 full years, from the end of Q3 2023 to the end of Q3 2025, those 2 years, the price of gold actually doubled over those 2 years. Now, yes, the Dow Jones went up, but it didn't double. So over the past 2 years, the Dow is down 33%. 33%. So they're going to talk about, this record high in the Dow. Yeah, the Dow dropped by 33% in terms of honest money, in terms of gold, right? And, if you have some gold dollars that were minted by the U.S. government right before 1933, if you have, a $20 gold eagle, not even like a collector's item, not like an MS-65 uncirculated, like beautiful collector's coin, but just your run-of-the-mill coin that you could just buy at Schiff Gold that that circulated and that doesn't trade that much above its melt value, right? Just one of those. In terms of that real $20 coin, you have a 33% drop in the Dow in 2 years. Now, I've been talking about this. The bear market has been even bigger because in 2001, when the Dow was at 10,000 and gold was around 250, the Dow was worth 40 ounces of gold. Today, with the Dow almost at 50,000, it's only worth 12 ounces of gold. That is a 70% decline in 25 years. So it's all BS, right? The media wants you to think, the government wants you to think you're getting richer. You're not getting richer. The numbers are getting bigger because the money is getting smaller. The dollar is losing purchasing power. You need a lot more dollars to buy gold, and so you need more dollars to buy stocks too. But you need even more of them to buy gold than you do to buy stocks. In fact, even if you go back to the peak of 1929, that was a very overvalued stock market. The Dow was worth 19 ounces of gold in 1929. Here it is, 96 years later, the Dow was worth 12 ounces of gold. So again, that's a 33% decline. See, people think, well, we're so rich because in 1929, the Dow was 360, and now it's almost 50,000. So we must be a lot richer now. Look at all that growth when the Dow went from 360 to 47,000. You wouldn't know in terms of gold, it went down. Because in 1929, when you bought the Dow Jones, you paid in gold because the dollar was gold. So if you took the exact same dollar and assumed no numismatic value, just take the same gold that you could melt down, right? The melt value of the dollars that you paid to buy the Dow in 1929 is more than the melt value of the gold in the same dollars today. So the Dow is lower. Now, that doesn't mean you didn't make money in the stock market over 96 years. Yeah, you collected a lot of dividends, although the dividend yield recently hasn't been that great. But the point is, the price of the Dow is lower, much lower. It looks higher because the numbers are big. But again, that is the illusion created by inflation. And one of the reasons that governments love inflation, because they make you think that you're getting richer even as you're getting poorer.